Good morning, welcome to this update on Monday the 1st of August, brought to you by Phoenix Blue. I'm Tom Colley and I'll talk you through the markets and the news this morning. Before we do that, just a heads up for our next free trading event, which is based in London, the afternoon of August the 24th. That's 4 hours free trading alongside at least one, if not two, of our Phoenix Blue fund managers. There's a lot more than simply trading to the day, though. You will glean a lot of information. You'll understand a lot more about how we trade the markets, how we analyse the markets, and really our overview of everything that we do here at Phoenix Blue. As I say, it's absolutely free, 4 hours on August the 24th. All you need to do is go to the website. This is the page from the website, the events page, and register for the next event on the 24th of August. That is unless you happen to be in Norway on the 18th of August, where we'll be doing the same there. Okay, guys, right, let's go over to the news. Last week we had a number of major news events that have shaped the market going into this new week and new trading month. We are in August. This is a low liquidity month. We can expect markets to be ranging more than they normally would. We'll be looking at those markets in a moment. We're looking at how we can trade the tops and the bottoms of the ranges, and also potentially trade intraday between those tops and bottoms. So although ranging can sound negative, it can to a certain extent give us more opportunity, but just of a different nature. Now, the real news that we saw out of Friday was we had the Bank of Japan monetary policy statement, etc. That was a disappointment for the markets. They'd expected something really significant in terms of additional quantitative easing. All they got was a limited increase in the purchase of ETFs, being another way that the Bank of Japan can purchase effectively Japanese shares. The Bank of Japan has a massive QE program already. It currently owns a third of government debt, and a large proportion of, or a very, very significant proportion of the Nikkei stock exchange. We also had gross domestic product from Canada, but more importantly, we had some bad gross domestic product figures out of the States. Now, we'd already seen downside pressure on the dollar from a disappointing, or shall we say, a very flat FOMC statement. So what we've seen there is an additional negative there, and on Friday that put a lot of pressure on the dollar and took out the majority of the previous month's gains on the dollar index. We also had the EBA bank stress tests, which actually were relatively okay, subject to what was expected, so we didn't see any significant move from that. Last night, or daytime in Australia, we had a bank holiday, but you'll see that detail is starred. That's because not all banks observe that bank holiday, so potentially not as significant as some other bank holidays, but still be aware if you're trading the Aussie dollar. Early this morning we had Chinese manufacturing PMI, this is the official government figure, coming in at 49.9 versus a forecast of 50.1 and a previous of 50. Anything below 50 is contraction, anything above 50 is growth. So we can see, let's just call this the Chinese government acknowledging that manufacturing is contracting. I don't believe that's a true reflection of the degree it's contracting, but the fact that they're acknowledging that would suggest that there is significant contraction there. Today we also have a Swiss bank holiday, so be aware of that if you're trading the Swissy. We're looking forward to manufacturing PMI from the UK at 9:30. We have a Canadian bank holiday, but again it's one that's not observed by all banks, so maybe not that significant. And 3 o'clock we have the US dollar ISM manufacturing PMI. Most significantly, overnight, stroke early tomorrow morning, we have a series of Australasian data coming out from the Aussies. We've got the building approvals, then the trade balance, then New Zealand inflation expectations, which should be significant or could be significant for that pair, that currency, and then most importantly, we have the RBA cash rate and RBA statement, and there is a good possibility that we might see a further reduction in interest rates on the Aussie. So be aware of that early in the morning or when you come to your screens, and make that the first thing you check before you consider doing anything in respect of the Aussie pair. Okay, over on the US dollar, well, we spoke about this bearish move through last week. The first half of it derived from disappointing FOMC statement. The second half from poor gross domestic product figures. We're at a key level now of around 95.40, 95.50. What we do from here will be significant. We have NFP on Friday of this week. That could be will be very significant if we get poor figures and we haven't already broken below this level. We certainly will be doing and heading for the bottom of the channel here at 94. If we get some strong figures, we can expect to see a return to the upside on this. So a lot of that will depend on what happens on Friday. Over on the yen, as we mentioned, we've already had some disappointing, from the market's perspective, Bank of Japan statement where they weren't offering anything like the levels of additional stimulus that was expected. The government did last week announce its own stimulus independent of the Bank of Japan, totaling about $266 billion US. There isn't any detail as to what that amounts to at this moment in time. We're expecting to see that tomorrow, so that will be something to watch out for. That won't necessarily be on your calendars, but it will be a stimulus coming from the Japanese government directly to the economy, not driven by the Bank of Japan. What we can see here is last week, disappointment from the Bank of Japan led to a strengthening of the Japanese yen. Remember, this is an inverse chart with US dollar strength up, Japanese yen strength down. We've got a significant level here at about 101.40. You'll see this here on the weekly chart that I've got there. Previously, historically, it's been very significant. We have the potential of creating this triangle here with price bouncing at that level. We'll be watching that level closely this week. Any break of that, and then we come down to a level of 100 where we believe we saw intervention back at this point, and even down to 99 where we saw intervention previously. That was actually, I believe, on the 24th of June, on the day of the Brexit result. So two key levels there. We will look to buy at those levels with caution because we can't guarantee intervention, but we've clearly seen it at those levels before. So if we get a break below 101.40 there, we will look for those intervention trades at that point. Now, I mentioned everything, or we're looking at markets that are potentially ranging. If you look through we go through the screens of the majors and minors one by one, we'll find all of them have the potential to be ranging. There's a clear range here between this 1.14 and whatever you want to call it, 1095 zone down the bottom here. We've got a channel in this area, so we will be cautious about anything that breaks long there until it breaks that channel. But plenty of opportunity intraday if we get a break above there, up to that channel, subsequently a break and retest of that channel further to the upside or to the downside. As I mentioned earlier, the term ranging tends to people to think, oh, the market's quiet and what have you. To a certain extent, it is quiet, but what it really means is it's more balanced. And if we can create a range, or we observe a range, then we have the opportunity to trade the tops and the bottoms, but also to potentially intraday trade the ranges, or between the top and the bottom through the day, looking to take money off the table and close trades within the day. Over on the pound, well, significant level here at 1.3475, 1.35. The big thing this week is on Thursday, we've got the Bank of England statement. Will we see a reduction of interest rates from 0.5%? Will we see a return to quantitative easing from the Bank of England? Those factors will have a definite effect on this market. If we get either of those, quite possibly we'll get a break above this key level here. If we don't get those, the disappointment from the market might see us below this level here, which is the 1.307 or 1.308 level, potentially for a break below, retest, and to take this market to the downside. Our bias on this market following Brexit remains bearish. If we get a break below there, a longer term target might be right down at about the 1.25. Can't say it's going to get there, but we'll look to take a trade, get half our money off the table, small profits, stop to break even, and then see if the market runs. We'll have no risk off the table once we've moved our stop to break even. So that would be an ideal opportunity for us. Okay, over on the Swissy, again, a clear range, clear opportunity to trade between the tops and the bottom of this range. Looks like on Friday we touched down at the bottom of the range in confluence with this trend line here. Obviously, if that does hold, we will be looking at, be cautious of this when price comes back down here, but as you can see we have plenty of potential, certainly intraday to the upside, before we get to the top of that range there. Over on the Aussie, well, we've already talked, we've got a rate statement overnight tonight. In principle, the Aussie and New Zealand, these are currency pairs that shouldn't really, based on their economies, be showing strength. But last week, behind the strongest currency, which was the yen, the Aussie and the New Zealand were the next strongest currency. This is predominantly because of the interest rates on these two currency pairs, or on these two countries. For instance, the Aussie has current interest rate of 1.75%, whereas New Zealand is up 2.25%. That compares with 0.5% at the next level being the UK, and a couple of other countries on that basis. That's significant because we're looking at interest rates that are 3 to 4 times higher, so money will go to these markets in the short term. That's one of the reasons we expect to see a reduction in interest rates to take the upward pressure off both the Aussie and the Kiwi. Again, both of those you can see working, or potentially working within ranges, giving us top and bottom and intraday opportunities. Over on CAD, similarly, we've got a potential for a range here. We've got a lower target here along with our upward trend line, and then a higher level up here that will give us a top potentially. Now, the thing to remember though is there is a lack of liquidity. We will be trading these ranges, but we'll be trading them at lower risk than we would be normally trading at other times because of the lack of liquidity. So nice levels that these are, the probability isn't as high as it would be if we had normal levels of liquidity. Now, overlooking at the S&P and equities, I looked at this morning and I had a range here that I was looking for potentially a breakout to the downside, but we've clearly this morning had a break to the upside. It could be a false breakout at this moment in time, but it would be an odd time of day for an American equities market to have a false breakout. So potentially we will see further bullish move on equities through this month. The S&P and the other American equities markets normally seasonally see a top through August, so we will be looking for a top. What I've got mapped out here is an AB equals CD pattern. What that basically means is a channel where we've got point A to point B and point C to point D, or potential point D, being equidistant. So then they're parallel, matching the same size. Once we get to this point, that completes the AB equals CD pattern, and then we'd expect to see a pullback of a similar magnitude to that movement there back to the bottom of the channel. So that would give us an exhaustion of the upward trend, the end of a pattern, and seasonality being a top normally reached on the equities market, and we would be looking for an opportunity to trade that to the short side and back to the bottom of the channel as a T2 type target. In conjunction with that, we've got the safe haven markets of gold and silver, particularly gold. Both these markets are due a pullback. We've long-term commitment of traders, extreme signals, which means the market is at a level where previously it has pulled back. So we'll be looking for some sort of double top formation here, a breakout of this rising wedge in order to take this down, certainly to potentially down to the 1250 level, which is potentially could be the turning point. I don't see a huge turnaround or a huge pullback in this market. The hot markets in general are cautious, so it's quite possible that we will at that point return to a risk off scenario, so the money comes out to a greater extent than the pullback we've just discussed on the S&P, and we'll see strength returning to gold, silver and other safe haven markets. You can see from this weekly chart here I've got a significant trend line coming back from what are the all-time highs through there, so real potential significant level there. If we were to see a break above the 1375, that would be another signal where we're ignoring another COT extreme, and I will be again looking to take this to the upside until the next significant level. Okay guys, well that's it for this morning. Hope you found that interesting. You will notice that we trade screens or charts without a lot of indicators. We use commitment of traders, we use seasonality analysis, and all that together allows us to trade with 40 pip stop losses predominantly on FX markets. If that's something you would like to know more about, simply email us at info@phoenixblue.co.uk if you've got any questions. Remember, we can visit the website or email us that address for the free trading afternoon on the 24th of August in London. So all that remains to say, good trading this week. Thank you for listening, and we'll speak to you in the morning. Take care.